I'm also the head trader of SMB Capital's options trading desk. So today, I would like to talk about trading in a sports analogy. Traders love to talk in sports analogies. And the floor manager here at SMB Capital in Manhattan is a guy named Carlton Bryant. And Carlton, when he's coaching and counseling traders, will often say to them, just wait for your pitch, which is a reference to baseball when a little league manager is trying to get kids to start to get more disciplined at the plate. He tells them to wait for their pitch. Don't swing wildly at every pitch that comes down the pike. Be choosy, be particular, and that way you'll be more successful. So why does the little league coach say that? And the reason he says that is that trading or batting is not a guarantee. The best batters in the world, the best hitters in the world will hit 300, meaning they fail 7 times out of 10. But they succeed 3 times out of 10. That's how difficult hitting is. Trading is also very difficult. So when you get your pitch, when you get a pitch that is good for your batting style, you're still only maybe 50-50 or 40-60 or whatever chance of actually getting a base hit out of that. It doesn't mean if you get your pitch you're going to get a hit. It means if you get your pitch, your probability of getting a hit goes up. And so great traders, great investors look at the probabilities of their trading and they try to get into the best situations where they are most probably going to have a win. So I was in a mentoring session recently with one of my very bright mentoring students from Hungary, actually. Very bright guy, Ivo, and he was talking about a study that he did in which he looked at success and failure of a certain trading style that he enjoyed to trade. And we were looking in the session at this back test he had done together. We were looking at the results of the back test. And in the spreadsheet, there was one thing that came out as very obvious, and that was every time he was able to buy a butterfly a certain number of days out from expiration, options expiration, if he was able to buy that butterfly below a price of $10, he won every single time. Now, some of that may be luck over the period that he was back testing, but it can't be all luck, and there's something to it. And what there is to it is when you get in at a lower price, your chances of winning the trade are greater. Just as if you buy a stock, the lower the price you buy the stock, the more likely it will be that you will make money on that stock. So it got me to thinking, is this a core best practice of a trader? And the answer that I've concluded is that it is. Yes, it is. And I think about the traders on our trading desk. The very top traders on our trading desk are all extremely hyper conscious of pricing. And I've noticed this. It comes out in different ways. Some of the traders get onto our shared software that we use and they model the pricing not for the current month, but they model the pricing for a future month, which we're not in yet, and they actually keep that model going until they see that the price of the option structure that they want to buy has gotten least expensive. And at that point, all of a sudden, we talk to each other on Skype during the day. All of a sudden on Skype, I'll start getting a lot of messages from our best traders. Hey, do you mind if I go into October now, which is early, or November? I'm seeing some great pricing in that month. I'd like to actually jump into that earlier. Usually my Skype will be ringing off the hook, so to speak, on a day when, because of the volatility environment or something else going on in the pricing of the options, all of a sudden a particular option cycle looks very attractive from a risk standpoint. And our best traders, our most consistent traders, are extremely aware of that, and they go in and they pounce. And so that's the nice thing about running a trading desk. I can wait for our best traders to tell me when a particular options chain has gotten attractive, And it's been more than once that I'll steal their ideas and go in and jump into that month myself because we're all sharing information with each other. We might as well benefit from that information. So what's the moral of this story? The moral of the story is be aware of price. It's a best practice of great traders. That's my observation with options traders. They're aware of what pricing is and they know when they need to pounce. Just think about it, if you get in at a good price, when you win, you'll win more, and when you lose, you'll lose less. Getting in at a good price does not guarantee you'll win, but it does guarantee one thing. It guarantees you'll lose less if you do lose. So patience is necessary in order to be able to exercise this best practice. And that is meaning that you may have to wait for days, maybe weeks, to find the right moment to pounce. And the good traders are aware of that. They're constantly looking at their modeling, and when they see a great opportunity, they take advantage of that opportunity. In other words, the best traders are patient and they wait for their pitch. That's how they'll get the best batting average. Translated into trading, that's how you'll make the greatest profit over time. It's a best practice. It's very important for us to share these things. That's what we do at SMB. We want to share with traders all over the world what we have learned from running trading desks here in Manhattan. So thanks very much. I hope that you'll take that to heart, start to model pricing in future months. Think about what trade you may want to go into in that future month and be ready to take advantage of a great pricing opportunity. That will be a best practice that will help you to improve as a trader. Thanks very much, and we'll see you next week.